Hello there, welcome if you are new to the channel, and please don't forget to subscribe. If you only like the content, you can just watch the video up until to the end, and if you enjoy the content, please do subscribe and hit that like button. All right guys, today I am actually analyzing gold stocks, actually the companies that mine gold in the mining industry now. So before I even go to their actually summary of their financial statements, I will just cover the fundamentals, in a bigger picture. Let's cover the fundamentals first globally, and then now we'll go down to the financial statements of this company, and then further we'll go down to what to the technical analysis to identify the points where you can actually enter effectively when you're buying these stocks. All right. So far, the US stock market and also the global equities, we've seen some volatility in the previous weeks actually, from the early of February up until now, the early of March. We've seen the stock market actually pulling back from their all-time highs from 2020. So the cause of this actually, it's been nothing but fear, as investors around the world, they are pricing in the possibilities of increase in inflation. So now that is shown here by this treasury yield curve. This is the blue line which shows the treasury yield, which has been increasing exponentially quicker. And then this one here, it shows the very same treasury yield increment for the past year, which was 2020. And then in 2019, it is represented by that one here. So if you compare 2020 and the 2021 here, you can see that the treasury yield curve in 2021 is increasing quite faster than last year in 2020. Now, this actually, it shows that investors, they are already pricing in the possibility of increase in what in the interest rates, which will be caused by what, by the increase of inflation. So they are already pricing in a rise in inflation, because of why there's been a lot of printing of cash now. As we're printing a lot of money, that increases inflation to a country that does that. So of course, due to the impact of the pandemic, a lot of countries, they've been printing money trying to stimulate the economy again. So that now has triggered a sell-off into the stock market, but specifically to the tech sector, the technology sector, because of why? The technology sector, it has a lot of growth stocks. So this growth stock actually, when inflation rises, and then now there is a potential that the central banks might increase the interest rate, those stocks tend to go down because of why they are growth stocks. Now investors, they are shifting from growth stock going to value stock. Reason why growth stock, normally they don't make profit now. No, people, they buy them with this hope that in future this company will be worth more, they will make more money. Now, meanwhile, what they do as they expand their business and invest into the business back, during low interest rates, they take loans from the banks in order to invest into the business and expand the business by taking advantage of of lower interest rates. And that was last year in 2020, when interest rates around the world were lowered almost to zero by a lot of countries. All right. Now, if now the treasury yields are increasing, which shows that there is an idea out there to investors that inflation might increase in future, and that might trigger the central bank to increase the interest rate, specifically to US and also around the world. So now that causes fear into the growth stocks, specifically the tech sector. And then now all those guys who bought those growth stock early in 2020, they are taking their profits, shifting their money into value stocks, specifically companies that they will actually be benefiting from a higher interest rates. And that it has been actually been shown from the market. This while the stock market was, the tech sector was actually falling, consumer cyclical stocks and also the financial stocks, they were rising, especially the credit service stocks, stocks that are within the credit service in terms of the industry. they were increasing. So the banks were also increasing in share prices because of why? If inflation goes up, there will be an increase into the interest rate. There's a chance that interest rates may go up. So if interest rates go up, the people who benefit there in terms of the businesses, it's the banks and the insurance companies. So that's why we've seen a lot of sharp drop into tech sector, and then also why there was less drop into financial stocks and also the consumer cyclical stocks. So it shows that the money is moving from the growth sector and also to what? To these value stocks into the financial sector and the cyclical sector and also real estate, including the energy sector. All right. So that is the bigger picture of the market currently now in terms of where we are. Now, going back to the main topic of this video today now as we go down to now the gold mining stock. Now, how does this have to do with the gold mining stocks? All right. Remember, guys, when the inflation goes up and then the interest rates are increased, the stock market will drop. And when inflation goes up, money becomes useless because of why it loses value due to what? Due to higher fast increase of what? Of the inflation. So investors, for them to protect their worth, not to hold cash, what they do, they buy what we call safe haven assets. So what are safe haven assets? Safe haven assets are actually commodities in most cases, such as gold and silver. Gold and silver, they are actually viewed or perceived as God's money, as Robert Kiyosaki says. It's God's money. So they store value. So if money will be losing value due to an increase into inflation, that cash will go into gold now. Investors will start buying gold and then now they will drive the price upward. All right. As we've seen, when the stock market was recovering actually, and the interest rates were quite very, very low, there was printing of money, gold started to do what? To go down. It was retracing because of the guys who actually bought gold during the crash in the pandemic in 2020. When the stock market recovered, they liquidated what? Their gold holdings. They actually sold gold and then now they went back to stock to buy what? Stock, because of why the interest rates were quite lower, because of why the central banks were printing money trying to stimulate the economy. Now the opposite is about to happen again now, where now the interest rates, they're going to go up to fight what? The high increase of inflation. All right. Now that is the fundamental side in terms of the bigger picture with the interest rate and then the inflation. Now let's go to actually potential stocks that might actually benefit from this. But before I even go there, I just want to show you a gold chart just to show you the drop of this so far. But I won't show you the specific gold chart. I will just show you an ETF, which is that tracks the price of the gold actually. It's an ETF that tracks the gold price. So it's called GLD. So this ETF, it moves, it's correlated to gold because it tracks the gold price. So when the gold goes up, this ETF goes up. So this is a price chart of this ETF. As you can see there, during the crash in 2020 with the pandemic, we had a crash. You can see that was the crash with the pandemic, but then gold went up sharply because of why it's a store of value. And then now, while the stock market was recovering and then money started to flow out of gold buying stocks, and then we had this pullback as the stock market was going upward. So to show you that, let me quickly go to S&P 500 just to compare the SPY, which is the index that is an ETF that tracks the index, the US stock market. So this S&P 500 actually, it represents what? It represents the US stock market. Now, here we had a crash, but then the stock market recovered. While we had a crash, you can see that gold didn't go down that much, but the S&P 500 went down very, very deeply. You can see this deep cut with this orange line. Then gold was just a bit, and then while the S&P 500 was still up there, gold was rising. And then now when the stock market also recovered, going upward, we can see that now gold started to do the opposite. Now it was going down. Now currently the S&P 500, it is up there. Why now was gold that turning around while this S&P 500, the stock market, was going upward? Because of why now money was moving out of gold, going back into stocks, because the stocks were recovering. Remember, investors, they buy gold when the stock market crashes, because why? It's a safe haven asset. Now we've seen the gold price going downward, and then the stock market continued to go up. This shows that the money was moving out of this guy, going back to the stock market. All right, because of why? Because of now it was a risk-off environment after the interest rates were lower, that such that most of the companies, they had chance to borrow and expand and grow their revenue and their profit with at a lower interest rates. But now if the opposite is happening currently now, which is shown by that treasury yield curve, if the inflation is going to go up, that shows that now there is a possibility that the central bank might increase the interest rates. When they increase the interest rates, gold will do what? The stock market will do what? Will go down. So if this stock market, if that happens, we will start to see a rise in gold prices going upward again. So now that's why I'm saying that there is an opportunity to these gold stocks, which they've been falling due to falling gold price. Remember, these gold stocks, they are very, very, very dependent to the gold price, which is the commodity that they are selling. If that commodity is going down, they will also go down. Now, before I go to the technical analysis of these companies, let's first go through their summary of their financial statements one by one. The first one that I have here, I will start with the worst one actually. Let me start with Harmony, not the worst one. Let me just start randomly with Harmony here. So I have Harmony, I have Goldfields, I have DRD, and then I have Sibanye Stillwater. So I'll be just summarizing through all these stocks, and then we'll be going to their chart and then comparing with the gold price again. All right, this is the summary for Harmony, by the way. No, this is not Harmony. This is what is that, John? Sorry about that. Let me just close this, and then I want to open Harmony. Let me open Harmony first. Harmony Gold. Harmony Gold. Come on. Yeah, there we are, Harmony Gold. Let's check the summary for Harmony Gold. Yeah, there it is. First of all, let's check the valuation of the Harmony Gold first. Here, this is a very good website, Guru Focus. So Harmony Gold, it is undervalued, but it is a possible value trap. It's one of those companies that you can buy because of why they are undervalued, but they don't go up over a long period of time as expected, due to what? They are perceived as value trap. You think that it's going to continue generating value, but it doesn't. Just stay there below that, because you must remember that when it comes to mining companies, we are mining what we call depleting assets. So as long as we're still producing these massive tonnages per annum, our assets are decreasing in value. So our own thing that you can expect a company to continue creating value over a period of time, unless that company is buying other companies like Sibanye. It's also doing exploration, finding new gold or reserve or ore bodies. But if it is not doing that, it's only mining what it has already found in the past years, you must know that there's no value creation there, because we are depleting the assets. It's a depleting asset business. As we mine these grounds, we actually tend to deplete them to such an extent that now we only have grounds with low values that are not economically feasible. So that's why I'm saying this. It could be a value trap. You buy it, you think that it's going to create value over a long period of time. No. Most of these gold stocks actually and commodity stocks, they are cyclical stocks. They only perform better when the prices of commodities, they are up there high. If they're not up there high, they won't perform good, they will do bad. So the best thing to buy is also to analyze the commodities themselves. When you see the commodities going upward, after you've done your top-down analysis like I did with the overall economy, what is happening currently now. All right, and then now you get an opportunity to buy them at the lower prices while you done your fundamental analysis from what? From the macro perspective point of view. All right, so now this is Harmony. It's rated as undervalued here, and with my calculator, I even calculated the intrinsic value, because here I just want to tell you, to show you the opportunity that you can actually capitalize on. So Harmony, you can see there's a lot of debt. First of all, that's the first thing that I don't like about Harmony. And in terms of the profitability, this is the revenue. You can see they only have a huge spike, the white spike here, which shows their revenue. That was 2020. Do you know the reason why we had that huge spike? Because of why the gold price was higher. Investors were buying gold, so Harmony benefited from that. And then you can see in the previous years, it's been too low, the revenue, because of what? That is, has to do with gold prices also. And then in terms of the net income, I don't see any, because net income in this graph, it must be represented by what? By the green bars, but it's none. It's not there. They didn't do well in terms of the net what? Income, meaning that now there's a possibility that these guys, they have too much operational cost. That is a bad thing again, which is why these stocks, you don't buy them and hold them for long term. You just buy them because they can now give you 100% returns within a few weeks. You'll see when I show you into the charts with the technical charts. Then if you go to their cash that they have into their balance sheet, you can see it's been increasing, then going down, then it was up in 2020. Why? Of course, gold price was higher, but the debt has been rising ever since. They've been increasing debt, so there is no value which has been added here into this stock in terms of their fundamentals. They are not like stocks that you can buy and hold them for 5 years, for 10 years. It's for quick term, like for 6 months, a year. You make that huge profit and then you are out. You sell them. You sell them to who? You sell them to people who don't do research, who just buy stocks. When they are high there later, they wait for the price to go up. When it's up there, they buy, and then you sell it to them. You just give them, you dump to them. You buy them at lower, you will dump it to those guys at a higher price. And then you can see this summary in terms of the debt and the cash and the revenue and free cash flow. This graph here is supposed to show free cash flow, the amount of cash that the company has after it has paid its operation. It must be represented by the red line here. You can see it's nothing. There's nothing here. The cash from operating activities, it was only up 2020 again. So you can see these guys in terms of financial performance, they're not quite doing well. Their cash flow from operating activities can't be seen here. And also their free cash flow, the amount of cash that they have after they pay their operational expenses, it's not there. But buying the stock for the next 6 months, anticipating that gold price will go up, it is a good one to buy. But for holding it for 10 years, it's a bad one. All right. So you can see in terms of financial strength, it's been rated as 7 out of 10, not bad. And in terms of profitability rank, it's 4 out of 10. That's reasonable. I mean, we've just seen that from their financial statements. They're not quite doing well in terms of the revenue and the free cash flow. Okay, that was Harmony. Now let's go to Goldfields, which is another gold stock. So you see a trend to these gold mining stocks. There is something common about their financial statements, which you can actually learn from this, so that even in future when you're doing your research and when you're buying these stocks, you can see. You see Goldfields here, it has quite good revenue, which has been increasing over the past years. That is good. Under this graph here, you can see revenue, which is represented by the white bars, has been increasing. The net profit, which is the green bars, has been erratic, increasing and then down and increasing. But 2020, they had a lot of revenue, but the net profit was actually, the net income was actually lower. But if you go to the cash and the debt in their balance sheet, they have too much debt. Look at the red bars. They've been increasing debt. And then in terms of the cash that they have, it's also been increasing, but their debt is too much. So South Deep, in terms of gold, within the mining industry, they are perceived in terms of their resources and reserve as the last man standing in the gold industry. They still have a lot of ground to mine. So they're going to be the next good play to speculate on in terms of what now, hedging your portfolio using that fundamental part that I explained in terms of the safe haven assets, because these are cyclical stocks. They go like this. They go in a wave like this. They don't go up. They go in. They tend to move with the economy. When the economy is bad, they go up. When the economy is good, the stock market is doing well, they go down. So they move relatively to the gold price. So they don't go up like this, trending upward. Over a long period of time, they go in cycles like this. So it's good to buy them when you're using them to hedge your portfolio, or when you use them to profit for that 6 month or that 1 year period, and then you sell them in most cases, unless you're buying them for different reason, for example, such as for dividends. So that is also good. So you can see here, it's Goldfields too much debt. They have less cash into their balance sheet, which is not something that you want to say to the company that you're buying. And then if you see their free cash flow, it's negative, it's below zero, meaning that now they don't have any cash left after they've paid their operational expenses. It's even negative, meaning now they're also using cash from what? From the investors, or they're using debt to finance the whole operation. That is proven. You can see this is their balance sheet. They have a lot of debt here with the red bars. Now the free cash flow from the cash flow statement, the amount of cash that they are left with after they've paid their operational expenses, they are left with nothing after that, because you can see it's negative. If it's negative, meaning there's nothing, it's below zero. They are using debt to finance the operation at some point. Now, if you check here, the white bars, which is operating cash flow, which is the cash from the operating activities, it's also not increasing steadily. It's erratic, up, down, then it was up. So it moves exactly like what? Like the gold price of this company itself, because it's doing that too. It goes up, down, but over a long period of time. So you only buy stocks when you are hedging them. All right. Now, it's the same behavior, different company, but same sector. The source of revenue is the same, is gold. Now, the company that is doing better, which I will show you, which is better than these two companies that I've just talked about, is called DRD. Now, I will explain to you why this company actually it has better financial statements compared to Harmony and Goldfields. The reason why this one is kind of better compared to this one, you can see their revenue is increasing. Good, nice. Their net profit, net income is increasing. Good, nice. You go to their balance sheet here, you see the cash that they have, the green bars, they're increasing. They have conservative debt. The debt is quite low. That is good. This is amazing to these guys. And then if you go here to their free cash flow statement, the cash flow statement, you'll see that the cash from operating activities, the white bars, they're increasing. And then now the free cash flow, at some point, yes, it was negative. The net income is also increasing. But overall, these guys, they have juicy financial statements compared to what? To other gold companies within the same industry. Now, the question is, why this company has this such awesome financial statements compared to Goldfields and Harmony? The answer is cost. You see, Harmony and Goldfields, those guys, the costs are high because of why they still have to pay for the labor. They have intensive labor. There's a lot of labor there, and then they're still paying for development for them to mine. There's a rock that contains gold, which is called reef. They have to do development. They have to develop access ways to reach that gold, that rock that has gold. So those are cost. They have to blast. They have to install support. They have to order all this material. They have to provide ventilation, which is airflow underground. Those are huge costs into the mine. Ventilation, material, and labor. Now, DRD does not have to do that because of why. DRD, what it does, it retreats the tailing or the slum dams. After we've taken out all this gold from the mines underground, we send it to the plant to be crushed and we extract gold. That is done by chemical engineers and metallurgical engineers. Now, the waste that is left out of that plant is being dumped to what we call a waste dump. But now, due to the inefficiency of our plants into the mines, we don't recover all the gold that is contained into the rock, into those plants. When we are discarding all that waste after we've extracted gold from the plant, that waste, it still has gold. So now, this company DRD, they are specialties into retreating that waste. They take that waste and then they send it to their advanced plant, then they retreat it to get gold out of it. Now they are on surface. They don't have to worry about ventilation. They don't have to worry about the labor intensive labor. They don't have to worry about support. They don't have to worry about development cost because they are on surface. So now they have relatively low cost compared to other companies that they have intensive cost for the whole operation. So that is their edge. So when the gold price is higher, they even benefit more because of why they can produce more gold, and then or they can still produce less gold but then sell it at a higher price, which increases their revenue. So now they have relatively small cost. Then now their net profit increases. So now they keep on creating value, and currently now they are concentrated into gold mines. But in future, with the advance of technology, they will even expand to other commodities such as platinum, such as zinc, the manganese, etc., etc. Imagine if that now they expand their business to even retreat other commodities or other precious metals or base metals. So that's the reason why this company, it has these juicy financial statements compared to its competitors, because of why they have less cost. They are only retreating tailing dams on surface. That's why. So if you were to buy for long term and hold the stock due to now the price of gold being down but has a potential of going upward, if you are a long-term guy, or a person, DRD will be the best one compared to Harmony and also Goldfields. Goldfields, they will be only for short term, a speculative investment. All right. So I hope that I've clarified quite well. And if you still enjoy the content so far, you're still with me, do subscribe and do hit the like button so that I can do this research and provide more content in terms of investing for retail investors. All right. Now, look at here their net margin, which is the net profit divided by their revenue, is quite high, 15. That is good. And if you check their return on equity, it is 19.82. And currently with this business of retreating tailings, I think they are the leader within that niche. They are leading. I haven't seen the other companies that do that. They are competitor. They are a leader within that niche. That's why you see that they have a higher return on equity and the net margin. That shows that they are a leader in that niche, and they are rated as 6. If you look even their financial statement in terms of the strength, it's 8 out of 10. That's good. Profitability, it's half, 5 out of 8. That is also good. But currently they are being rated as overvalued. They're trading below their true worth, their intrinsic value. But since the company is tied up, actually it's dependent to the gold price. That might not play that huge role when you're buying it, because if the gold price is going upward, this stock can shoot back upward and be even more overvalued. So in this case, I would also, even me myself, kind of ignore that if I see gold price with the huge potential of going upward. So this was DRD. Now let's go to Sibanye Stillwater. Then here is Sibanye Stillwater again, because it's also another company that actually mines gold, but this one is hybrid. It's involved into different commodities. It's gold, it's platinum, and recently they are actually about to buy another company again in Europe, which is also involved into lithium, that mines lithium. So they are also capitalizing on the electrical vehicle trend with these electrical vehicles in the auto sector. So they, of course, lithium plays a very, very huge role there with the lithium batteries. So we can see the revenue for Sibanye has been doing quite well. That is nice. And the net income has been increasing, especially last year. But they have a lot of debt here. You can see the debt has been increasing. But in 2020, funny enough, the debt was quite low, as you can see that, but the cash was increasing into their balance sheet. That is awesome. The debt now is being reduced, but the cash is being increased. As you can see, debt is going downward, but now cash is going upward. That is good. And the reason why Sibanye has a lot of debt into their balance sheet is because of why they buy assets, they buy other mine companies. Remember, initially they were only concentrated into gold operations, with the gold shafts and gold mine, but then they went outside now into other precious metals such as platinum. They bought companies from the platinum mines such as the likes of Marikana there in the northwest and Krondal. So they are also involved into platinum, and I think they are the third largest platinum producer around the world, if I'm not mistaken. And then now they're also branching into lithium commodity now. The lithium, they want to be involved into that one to take advantage of the rise of electrical vehicles around the world. So you can see they're kind of a diversified mining company which tends to profit from different commodities. So that's good. They are diversified. That's a good thing. And if you check their cash flow statement, it's also not that bad. You can see the net income is increasing. That is nice. Net income, which is represented by the blue lines, is increasing. That is awesome. If you check the free cash flow, the amount of cash that they have after they paid their operational expenses, it's also represented by the green bars here. It's increasing. That is awesome. And if you check the cash flow from operating activities, which is represented by the white bars here, it's also increasing. That is awesome. So overall, Sibanye, it has juicy financial statements, just like DRD. And Sibanye also owns, I think it owns 50% of DRD. Sibanye owns 50% of DRD, if I'm not mistaken, on that one. So DRD and Sibanye, they are actually a good buy, but it will be like you're buying one company, but it's fine because Sibanye also owns DRD. Even if you buy Sibanye only, it's still fine. And the nice part, Sibanye is undervalued. It's trading below its intrinsic value, the actual value, which is represented by the black line here, according to the ratings from Guru Focus. And if you check their net margin, quite good, amazing, 23%. If you take their net income and you divide it by the revenue, that is 23%. Normally it has to be above 20 or 15%. That's better. Now this one is 23%. Awesome. If you check their return on equity, how efficiently are they using the money from the investors, shareholders? That is 60%. Normally you're looking for something like 12, more than 12%. If it's 60%, that's even far much better. This is awesome. And then if you check there, the financial strength, they are rated by 6 out of 10. That is good. And if you check the other parameters that have been used there for the financial strength, such as the Petrosky F score, it's 7. That is good. And then ultimate Z score, the probability of a company going bankrupt, medium, 50-50 chances, but that's not that bad. Yeah, so far Sibanye looks quite good for a buy when the gold price goes up too. So that's it with the fundamental sides. We've seen that Goldfields and Harmony, they're quite doing bad in terms of their financial statements, which is financial performance. And then DRD and Sibanye Stillwater, they look quite good, but be warned on Sibanye Stillwater, because there's this a Binish score, which actually score a company if it manipulate its earnings report or what. Here I see manipulated. I'm not sure about that, but it's one of the things that you should look out for as an investor, if they're actually reporting quite good stuff or they're just lying. On that one, I have no idea. I'm just reading financial reports from website and also from their website. So on that one, it is something that is debatable. Even to other companies, I mean, you have to do your due diligence when you buy these companies. You cannot just believe everything that they say to their financial statements. So the only thing that you actually now check, it's the price. Yeah, the investors buying the stock now. That is the addition that you do to your research. As of them being not a manipulator, here being rated as a manipulator, I'm not sure about that one. I'm not going to spend a lot of time on that one. All right, now let's go to the price charts and see the juicy things. First, let me just remove this S&P 500. Yeah, now we're going to go to Harmony first. Harmony, the price chart for Harmony. Here is Harmony. No, that is the one listed in US. I want the one that is listed on Johannesburg Stock Exchange. Harmony. Here, JSE. There's our guy here. Ta-da! You can see here Harmony Gold has been doing quite well, and during the pandemic we went up in terms of the price action. We went up, we rallied up in waves. Remember, the price goes up in waves like this. That is an uptrend. The price is trending there. So during the crash and the pandemic, the price has been going up quite well since from 2019, and then 2020 we just went up. Now since the gold price has been going down, correcting, even Harmony has been doing what? Going down. And then now we are back to these lines here, which I call them. They are called moving averages. They act as support to the price. You can see every time the price comes back to these lines, it tends to bounce off and goes up. And then now it's back to these lines, which is the opportunity to buy some shares with the hope of what? Of the price going upward. This is from the technical side, but we already seen the fundamentals that they're actually looking good in terms of the possibility of the gold price going upward. And that if it happens, this price will shoot up again, doing the very same thing that it did during 2019 when we had a crash, as investors were buying gold as a safe haven assets to protect their wealthy. You can see the price, it's been trading from the all-time highs here. It was around 120s, then we dropped all the way to 63. So that is almost like a drop of 50%. So if you buy now, you have a potential of making what? From 63 to 120 or 123, we have a potential of making more than 80% returns on investment. That could happen within a year, within 6 months, within weeks. I don't know. The market will lead. So now this is the potential that I'm seeing here on the gold mining stocks. So the price chart of these gold companies currently is the same except for Sibanye. Sibanye is already up. So let's check Goldfields, GFI, which is Goldfields. Here is Goldfields. It shows the same thing. The price went up during COVID. It was up from 2019, pulled back, and then we went up again. Now we are back to these lines here, which I call them moving averages. They are known as moving averages. We are ready to bounce and go up again because they act as what? As a support line. Only if the price is in an uptrend. But if it's going sideways, don't use them. Use them when the price is in an uptrend. When the price is in an uptrend, it goes up, comes back, goes up, comes back, goes up, comes back. And then these lines, they will be arranged in sequence with a small one on top, followed by the other one, small one, but which is bigger than the one which is on top, then followed by the bigger one. So here I have 50 on my moving averages. Here I have 100, and then here I have 200. As you can see, they are here. The blue one is 50 and 100. And then they're in sequence like that. If the trend is upward, that is how you identify a trend. So you can see there is the same characteristics here. They behave the same, these gold mining companies. They are attached to gold in terms of their profitability, and also that has been shown to their financial statements. And then also with the price chart, you can see it's a different one. It's Goldfields. Then now DRD, it has the same characteristics too. Let's check DRD from Johannesburg Stock Exchange. There is JSE, same thing again. The price went up, came back, went up, now it's back. It's coming back this side. And then this is the point where you actually accumulate shares and buy, and looking forward to make above 80%, because the share price dropped about more than 50% from the all-time highs to where it is. Don't be the guy who buys here. Imagine the guy who bought here. Now he's losing his cash. He's down by 50% because he bought at a wrong time when the price was highly overextended. He bought when the stock market was bouncing off, when the money was moving out of gold assets to stock market, because now it was a risk-off environment. So if you don't do top-down analysis, this is where you get lost, and then you're buying at the wrong time, and then you're buying stocks that don't go up over a long period of time, but they are cyclical. Because of why? Mining companies, they are mining a depleting asset. So over a long period of time, the value have to go down there unless they sink more shaft, they discover new ore bodies. Now let's check Sibanye, SSW. That's Sibanye Stillwater in Johannesburg Stock Exchange. Now Sibanye, it is up there. Quite interesting. Why is it up there? Of course, the reason why Sibanye is up there, the platinum price, and also investors that are buying Sibanye, because Sibanye keeps on increasing value by acquiring more assets. Right now, they are negotiating. Actually, I think they've closed the deal of buying that lithium company in Europe. There's news that they want to buy a lithium company in Europe. So you can see that the price is already been increasing because of why it's pricing in now the profits that they will be getting from the electrical vehicle industry, because they use lithium batteries for energy storage. So that is already been priced into this. And currently now we also have a Benstone project in Mpumalanga, which is Spain is gonna spend around 2.3 billion there for the project, which is another shaft in Penstone another operation for Sibanye that is going to open and mine gold. So they still have a lot of reserves and gold. So that's why now Sibanye is going upward. There's quite confidence to investors in terms of the company creating value. But in terms of the valuation, it is still undervalued. But will I buy it here? No. I will wait at least a pullback to come back to these lines here or the blue one. And then that's where I will be buying so that I can catch the next wave upward. All right. So that's it so far. Let me quickly show you this news for Sibanye, which you can just use this website called investing.com. If I go to investing.com and just type Sibanye, you'll see there's a latest press release about the company, what's happening about the company in terms of the news. Any company, you can just use this website. It's one of the most useful websites called investing.com. Again, don't forget to subscribe to my channel if you like the content and you want to learn more and you are a retail investor. So this channel is made for retail investors. I'm also a retail investor, by the way, but the advanced one with a lot of knowledge and skills have been around with the market. So if you want to learn more on this channel, just do subscribe and don't forget to smash that like button too. Alright, this is Sibanye. You can see these are the latest press release about Sibanye update. South African rand recovers deep. It's just about the rand. Let's check news about Sibanye. Sibanye still wanted to invest in European lithium company, Caliber. That's the name of the company. Sibanye still wanted to invest in the same thing again. You can just go through this press release, recent press release news. Sibanye still wanted to announce investment agreement with Caliber. So these are great news for Sibanye Stillwater in terms of expanding its asset, and it's rated here as a strong buy, and it's paying dividends at 5% again at 3.71, and the next earnings release it's at 6.21. So there's a lot of information that you can get from this website about any company that you are actually interested to invest on. All right, guys. With that being said, I have came into the end of this video, and if you like the content, don't forget to smash the like button and subscribe, and then I will see you next time. Bye.